Hey guys, Toby Mathis here, and today we're going to be talking about these new Trump accounts. And so I invited a tax attorney, Savannah Wallace. Welcome.
Thanks, Toby. Glad to be here.
Great to have you. And we're going to be going over how to use them, what are the benefits, what are some strategies you can use. And for those of you guys who have a family business that's a corporation, there's some special benefits for you guys. So why don't we just start and give me the overview of what these things are and how you take advantage of it.
Sure. So these Trump accounts, or 530A accounts, were created under the One Big Beautiful Bill. And it's another way for you to be able to save and invest for your child. This is another account that you are able to make contributions to so that they can use that money for education expenses or save for retirement. So this is going to go along with all these other tax strategies that, Toby, I know you have other videos on as well, but can be a really great way for you to be able to jumpstart the investment journey for your child.
All right, so let's dive into this. You've probably all heard about $1,000, then there's $5,000, there's $2,500, all these different amounts. There's an extra $250. I want to break those down, but this basically means any child under 18
Correct.
with a Social Security number can open a Trump account, right?
That's correct.
And unlike IRAs or whatever, they don't need to actually have earned income.
No, they do not.
And
it's a huge distinction there.
Can you walk us through who could put money in? Like where does the money come from? So if I open up an account, it depends on how old the child is as to whether they get the extra, what is it,
$1,000.
What is it? It could be up to $1,250, right?
Correct, yes. So we have a couple different contribution options here. So first one's one of the most exciting ones, which is the $1,000 seed money that comes from the federal government. This is specifically going to be kids who are born between the years of 2025 and 2028. Now, of course, if you are, as long as you're under 18, you can still open up this Trump account. We're just not going to be eligible for that $1,000 seed money from the federal government. Now, if you do live in an area where the median income is under $150,000, you're also going to be eligible for an additional $250, actually donated by the Dell Foundation.
And how do you know if you qualify?
You can look it up online where you set up your Trump accounts. It'll give you a place to be able to search there.
Okay, so there's the $1,000 to $1,250, and is the $1,000, are these both tax credits, or how do you get the money?
The money is going to show up in the Trump account once you have set it up and shown with that valid Social Security number your age. So it gets contributed directly into that Trump account.
Okay, so they're just putting the money in. You don't have to go through and try to take a tax credit or anything like that?
No, you do not. They contribute the money directly.
All right, and if you're eligible for the $250, they throw that in there too?
Correct.
So you literally open up an account, and magically there's $1,000 put in there.
There's some government magic involved, yes.
Okay. Now, what if you're not born between 2025 and 2028? Then if you're under 18, you could still take advantage of these. What does that look like?
Yes, you can still take advantage of it. So the way to set up an account would be to log on to the online portal. There is a way to be able to set up an account that way. If your child was born in 2025, you're actually going to do this on your tax return. So if you haven't filed your 2025 return yet, and you've got a child who was born in 2025, make sure your accountant is aware of this so that they can assist with setting up the account. If you did already file your tax return, you'll need to do an amendment to get this account set up to take advantage of that $1,000 seed money. Otherwise, you'll just use the online portal to set up the account as long as you're under 18. And then from there, you're able to make contributions. So that's where we're talking about that $5,000 contribution limit that can come from friends, that can come from parents, that can come from grandparents. Any relative can make contributions, but also employers can make contributions to these plans too.
So let's just say that I have my own company, Toby's Pizza Parlor. I'd love to have that. And I have a child that's under 18. The company could make a contribution? And if so, like, how much?
Yeah, so the company can make a contribution. It can make a contribution of up to $2,500. That's going to be a contribution limit per employee.
So if I work for my company, and I have no other employees, even though my child does not work for the company can put $2,500.
Correct.
Can it write it off?
Yes, that is going to be a business expense for the company, and it's also not going to be included in any of your wages either.
Okay, so I get a deduction. The company gets a deduction. I don't have to report it as an employee.
No.
My child now has $2,500. That's that limit. And then me as the parent, I could put another $2,500 in.
You as the parent, yep. Me as a friend can make a contribution. Grandparents, aunts, uncles, anyone else can make a contribution up to that $5,000 limit.
And that's anybody under 18 as of any particular year, or is there certain years where they're allowing contributions to be made on behalf of somebody, or is it just anybody who's under 18 during the year?
Anybody who's under 18 during the year. The contributions are going to start on July 4th of 2026.
And then do they end at some point?
So there's a growth period with these accounts. It's from when you set up the account to the December 31st of the year prior to the child turning 18. So it can potentially be up to an 18-year growth period.
But I assume these aren't going to go on forever. Do they stop? Is this only for 4 years? Is this something that we can do indefinitely? Does it sunset?
Right now, there's no sunset provisions. This does look like something that's going to be around for quite some time.
Okay, so it's just for anybody who's under 18, anybody that's born during particular years, 2025 to 2028, they get this
Additional.
The government's going to put
$1,000.
extra money in.
Correct.
And the Dells put some money in.
Yes.
And that's never going away, or is that just a threshold?
I have not seen anything about this going away anytime soon. At least for up till 2028, that's when that seed money is. There's no other guarantees of additional seed money past those years.
All right, so let me walk you through. So I have let's say I have a 10-year-old. Then the company, maybe my company puts in a tax deductible contribution of $2,500, and then I put in $2,500. Do I get a tax deduction for putting that money in the account too?
No, you do not.
Okay. So the tax deduction comes from the corporation.
It's a business expense, correct?
Yeah, but individuals, this is it smells a little bit like a 529 plan.
It does, yes.
But you don't use these the same way. Like what's a good strategy for somebody who's doing this? Maybe they have 3 kids. I mean, you can isolate it just to one of them, but you walk through a use case scenario.
If I was looking to prioritize education expenses for my child, a 529 plan is certainly still something that I want to have in place. But if I also want to help my child invest in their future and start saving for retirement, I'm going to want to set up this 530A plan or this Trump account as well. Because once my child turns 18, it does convert into a traditional IRA. At that point too, I could even implement a Roth conversion strategy because my child is, below that threshold and doesn't have a very high tax bracket, which they probably won't. I'm not too concerned about how much they're gonna end up paying in taxes on that conversion. So that could end up being a really powerful strategy to convert what could potentially be almost $180,000 in an account, convert that at that point into a Roth IRA and just continue to let it grow.
Okay, and so let's go through. Let's say a newborn. And they put $1,000 of seed money, so they're going to get that for, let's say they were born in 2025.
Yeah.
So their winner chicken dinner. They're going to get $1,000 at least for 25, 26, 27, 28.
So it's going to be a one-time seed contribution.
Okay, so it's only $1,000 one time.
Correct.
Okay.
Yeah.
So they get the seed money, but then let's say that my employer contributes and everybody else contributes, and they get $5,000 a year. So the first year they get $6,000. Then after that, it's $5,000 a year. Let's just assume that it grows at 7%. Ballparks.
Yeah.
What are they going to get?
So at the end of the growth period, so that 18 years, so let's say my kid born in September, we make that $1,000, or we get that $1,000 seed contribution. Then we make the $5,000 every year. The December 31st, before he's going to turn 18, that's the end of the growth period. At that point, he could have up to $179,000 in that Trump account.
And it really depends on what the market does. So
it does.
If SpaceX blasts everybody into space and it's worth $1 gazillion,
exactly.
$1 gajillion is a number, then there's a whole bunch of money sitting in that account. So let's just say for the 7%, sounds like you're at 179. Could you convert that into a Roth at that point?
Yeah, absolutely. After that, you can convert it into a Roth for
Or
sure.
you could just let it roll.
You could. So I could keep it as a traditional IRA if he made no other contributions to that plan after that growth period. By 59 and a half, we're looking at about 1.6 million. Potential that could be in there.
Every child here, if you do this, then should be a millionaire when they retire if parents and business owners, because here's the thing, my tax brain breaks up.
Yeah.
I'm used to IRAs, you're getting a deduction going in and you're paying tax coming out, or you're not getting a deduction and then you don't pay tax. Here it sounds like you didn't get a deduction unless you used a corporation,
Correct.
S or a C, to make contributions. Then it's only half of the contribution can come from those sources.
Correct.
But you still have to pay tax on the rest, even though you didn't get a deduction.
So, correct. Yeah. Even though you didn't get a deduction, you are still paying the taxes, the ordinary taxes when it comes out. But for anything for contributions from parents or grandparents or friends, all of those are made with after-tax dollars, so that's not going to be taxable.
Oh, so that portion.
That portion,
but
correct.
the growth of it
yes,
would be taxable.
Yep. So standard IRA rules there.
So they're just getting back their contribution. So like, hey, if I put in, you said I was 179, some of that's seed, some of that's whatever. A chunk of that is going to be coming back tax-free, and a portion of it's going to be taxable. When they do the conversion, then, would it be the entire 179 or just that difference?
They can convert the entire 179.
But if they didn't deduct a portion of it, so there's part of it that would be returned tax-free, I'm assuming that wouldn't be taxable.
No, it would not be at that point.
Yeah, so it's not going to be the full 179.
Sorry. Okay, I see what you're saying.
No, I'm making it difficult so that if I'm putting in money and if some of it's after tax, some of it was tax deductible from the corporation,
Yes.
right? Then that one I'm assuming would be taxable to convert.
To convert, yes.
Then we do the conversion, and people are going to ask, why would you do the conversion? If you're doing this when they're 19, 20, 21, you do partial conversions, it's taxed at your ordinary bracket.
Yeah.
Right?
For an 18, 19-year-old, that's going to be potentially in the lowest tax bracket.
That's going to be that's when you do it, guys. You don't do conversions when you're in the high tax bracket. You do it when your tax bracket's going to be up. You don't do the conversion when your tax bracket's going to be lower in tax. But anyway, so I mean, it just sounds like that would be a potentially huge
strategy there for absolutely. For retirement savings, 100%.
Yeah, and it sounds like there's two big ones, unless I'm missing something. Number 1 or 3, free money, and it's not taxable, and that's fantastic, the $1,000 seed.
Yep.
The C Corp or S Corp making payment, I assume there has to be an accountable plan or something, or you have to be an employee.
Yep, so the employer is going to need to have what's called a Trump Account Contribution Plan, a TACP, in order to make those contributions.
Wow, so that's a big one.
That is
and
going to
then
be a
the
big
Roth conversion. Am I missing any?
Well, on that is the fact that while you can do the Roth conversion, after it turns into that traditional IRA, I think the big thing is that you don't have to have earned income to make these contributions, which can be, so even if you don't have your own business, you can still be making these contributions to an account for your child.
Yeah, and it's not like I have to have them work, like a lot of times with Roths, they have to have active income. Here you don't have to worry about that. Now, I'm just going to throw a few things out.
Sure.
You have the 529 plan really for education.
Yes.
Would you say still use that?
For education,
Yeah.
I would, because the withdrawals for those qualified education expenses are going to be tax-free from a 529 plan. They're penalty-free from a Trump account, but not tax-free.
Okay, penalty-free but not tax-free.
Correct.
The Trump account just sounds like just a play for retirement.
That is kind of the push, is to help them start saving for retirement from potentially the moment they're born.
Okay, now to be a doomsdayer.
Okay.
What happens, you set this up, you fund it, everybody's doing it, and something happens to your child before they're 18?
Yeah, so if the child does pass away before they're 18, similar to an IRA, it is going to go to, it can be designated to a beneficiary. It can be taken out at that point.
Okay, so this is similar to, let's just say, IRAs, 529 plans, life insurance, and there's going to be a beneficiary.
Correct.
And we want to make sure that we're specifying.
Who's that's going to go to?
Yeah, but all things being real, like this just sounds like a massive boon for somebody for retirement. But at 18,
Absolutely.
these kids are going to get access to that money.
Yes. 'Cause
So you still have to teach them.
wise money habits. Absolutely.
Don't touch it.
No, we want to hold on to this because, I mean, this, like you said, I mean, the kids can be millionaires by the time they're ready to retire just from this account.
Yeah, so we just need to make sure that we're playing a lot of MC Hammer. Can't touch this. Don't touch this. Right? Yeah. Don't touch the account because you're going to get in the way of the compounding. This thing, you're going to make your kids millionaires if you do this.
Yeah.
Now, what if you have 3 kids? Could you do $5,000 per child per year?
Yes, so the contribution is per account.
But the corporation is
$2,500 per employee,
right. So
not per child.
what if the kid is an employee? Let's say they're 16 and they go to work for the company. Under that, let's be real, if it's a family business. But let's say it's Toby's Pizza Shop and I have 3 kids. Could the employer make contributions to their account?
Yeah, if they are an employee, they'd be an employee of the company, and so the corporation would be able to make a $2,500 contribution to their account.
I hope you guys are kind of seeing that there's plenty of opportunities here and that this is new.
This is new. There's still a lot of things we're waiting on, especially when it comes to setting up that TACP plan that I talked about, waiting for the IRS to release some opinions. So this is going to be something that we're going to be watching ongoing as things continue to develop. But at least the framework that's already in place is still going to be incredibly powerful for your kids to have already in place to help them save for retirement.
Okay, we'll make sure that we post updates as things come out.
Absolutely.
Savannah's expert at this stuff. Also, if you have questions, put them in the comments, please, and we'll go through that. A question I have is from a tax standpoint, and we just went over seed money, $2,500 from company. We have grandparents, friends, other family members putting money. Who's in charge of tracking the basis and all these things? Because we know there's going to be basis tracking requirements here.
Yeah, so while the child is under 18, it's up to the parents. The parents are going to be essentially the custodians of the account and overseeing everything. Once the child turns 18, it becomes their responsibility.
And what would you do? Would you just put a file and says, here's the basis on these and write down, when I set these accounts up, here's what I did?
Yep, that's exactly what I would do. I'd have a plan in place, already kind of going along with coming up with plans for estate planning, showing them what they need to know if something happens to me and dad, or it happens, if something were to go on. Here's what you need to know about your account. Here's where it started. Here's what we've been putting in, and setting up those rules and making sure they know where that information is.
All right. Savannah, you've been more than generous with your time. I hope you guys learned something. Is there anything you want to add?
Go set up those accounts. You can start making contributions on July 4th.
Good luck, guys.